Hello and welcome to today's episode of Nucleus Investment Insights. With the PBOC, China's central bank, cutting interest rates just this week, and the country's property and lending data continuing to deteriorate, we've decided to take another look into the Chinese economy and see whether the latest week data is just a blip on the radar or a signal that ongoing issues are about to unravel the Chinese economy. So to do so, I'm joined by Nucleus Wealth Chief Investment Officer Damien Klassen. Hey, Damo.
Shelley.
And our Chief Strategist, David Lewellyn Smith. Welcome, Dave.
Hi, Shelley.
Rounding us out today is, of course, myself, Shelley George, Chief Operating Officer at Nucleus Wealth. And we're all coming to you today from the lands of the Wurundjeri people of the Kulin Nation. All right, so what are we going to look at today? So on the agenda, to help us answer this question, we'll be looking at whether China are able to beat OMICRON, the potential capacity of monetary and fiscal policy from here, the impossible trinity, and of course the Yuan, among other things. So before I hand over to the pros, just a quick message and reminder that if you enjoy our content, please subscribe to our YouTube channel and click the bell to be notified when we go live or have a new episode. Or, of course, you can do the same on your preferred podcast platform, as it's available on all the majors. So, Dave, where are we going to start?
From the top.
We're at the top. We're halfway part of the way down, at least, Dave.
Yeah, halfway by the looks of things. China's property crash is a great place to start because it's been so persistent over the last 18 months and has really... So, we think that basically the CCP is relatively comfortable allowing this property adjustment. That said, they have done at various points tried to prevent it from falling too fast within a context of understimulating, I might add. This property correction is now much bigger, much more sustained than we've ever had before. As you can see in the chart here, which is, rolling annual starts, we're already at levels of starts that we saw in 2015, and we're still not seeing anything like the stimulus that came during that period. And, even despite having a small rate cut this week, it's been very understimulatory on monetary policy especially, but even arguably fiscal.
Actually, Dave, can I just explain that chart for anyone listening in on the podcast? So we've got the annual property starts, and they sort of start at sort of 700 back in. Well, let's just don't worry too much about the units, but 700 back in 2006, and even at that point in time, they were talking about it being an unbalanced economy in China. They then basically tripled it going into 2010, 2011. 2016, so you sort of fell from sort of roughly 2,000 back to sort of 1,600. From there was another big push upwards, and post that sort of period, sort of into 2019, 2020, there was sort of this massive property push again that sort of brought you right up to sort of 2,300, and then since then we've fallen right back to the levels of 2015, and we've got this sort of...
As Damo was about to say, the orange line there is an extrapolation of current sales levels, and it's still falling away pretty sharply, down about 30% year on year. And so that rolling annual assumes that those sales levels will continue till the end of the year and kind of slowly steady. And as you can see, that's another material downside to anything and everything pertaining to property construction in China, which of course is going to include a lot of commodities.
Yeah, and so that leaves you at levels roughly half of where we were sort of 2020, 2022, but still above the levels where China was worried about how much overbuilding was happening.
Yeah, it can go much lower over subsequent years, and the evidence of that is in the huge inventory that's still hanging around in China, which has gotten much worse over the last 18 months after a few good years of running down. And that doesn't even that's unsold inventory before we get to the sold inventory, but empty inventory in the hands of investors, some 90 million apartments, which could also hit the market at some point if the general consensus becomes that property has stalled permanently in China, which it probably has. So,
in terms of the amount of building on at the moment, if you basically made the assumption that about sizes and Chinese the number of Chinese households, there's roughly one apartment under construction for every 6 Chinese houses at the moment. So there's still that's just unfinished. Yeah.
Yes. So it's an enormous screw up, basically. So we've seen a couple of recent attempts to fix it, most particularly 2 of them. One was supposedly a bailout mechanism that was going to assist these struggling developers to at least build the apartments that they owe, that is, complete the process, and to try and get around this counterparty risk that's developed between buyers and crashing developers. But having been promoted through a couple of leaks, that's disappeared, and instead what seems to have happened is some kind of issue of who is responsible by either local or federal government, and so there's now some local governments doing bailouts to generate further completions, but there's no federal fix at this point. And the second one was that we did have mooted special allocations of local government infrastructure bonds that were supposed to come in and try and help fill this construction gap, and that hasn't happened either. What we have had is accelerated issuance of this year's debt allocation, but we've had nothing further, and we're getting pretty late into Q3, so I'm not sure that's coming either. And so, again, this goes to the point that China is really understimulating here in terms of reaching its own growth targets, and in fact, it has given up on those growth targets, explicitly de-emphasizing the growth targets after the last Politburo meeting. So those looking for a quick fix here are very likely to be disappointed. At some point, all of this, which will comprise sooner or later a whole lot of bad debt, is going to land on the banking system. Perhaps then that will be enough of a crisis for Beijing to flip over and change its various macro-prudential measures that have created this crisis in the first place very deliberately. But I wouldn't hold your breath for that either. It really does look to me like a structural change flowing from Beijing. And it is going to take some very, very nasty shock for them to change their minds, I think, on this, because it has such kind of policy rationale behind doing it. So I actually think that this is a real analogy for Japan 1989, where the Japanese development model reached a sort of apogee in an orgy of debt and real estate, and then subsequently crashed from an average growth rate of 5% to under 3% forevermore. So I think that's the analogy that we're looking at here. There may be ebbs and flows in that, but I think that's the basic story. So, okay, can we flip over
and actually, just a one quick sort of putting in context again, is that there's effectively 2 main ways you can resolve these crises. One is you can go through like what you saw in Spain or the US or Iceland, a place like that, where we have these big property crashes. All these people have massive debts and go broke, and then you sort of start again. You sort of wash away all that debt and off you go. Or you can go the Japanese solution, which is you bundle all the debts into there. They do it into companies. Here is probably going to be into state-owned entities or government-run banking issues, and then you let the problem sort of fade away over a number of years, and you have this low growth for a whole number of years. So it's either pain up front and then get back to growth, or you just have reduced growth for a long time. And it looks like China's chosen the second way.
Yeah, I'd agree with that. So the next couple of pages are just some more property charts. Probably just skip over those. Shelley, if you don't mind, just pop down another page. And we're on to the second problem facing China, which is almost certainly exacerbating the first. I don't want to. I'll back one, please. Yeah, thanks. I don't want to say that that the property bust is in and of itself happening. I think the fight against Omicron is probably making it worse. And China has sort of found a semi-solution to fighting Omicron in mass testing, but it's not really a solution. It sort of is, because they don't lock down for too long, and they don't lock down too many people. But when they get these outbreaks of COVID across the nation, they are forced to lock down very regularly, and that's got all sorts of implications for spending, for investment, all of them negative. And we've seen, basically, after we had our big Shanghai lockdown earlier this year that really hit the economy very hard, then a reopening in Q2, and the economy bounced really well. But then we got this July data dump just the other day, and that grand reopening that had come out of the Shanghai lockdown, but then gone into this mass testing regime, just has faded in a matter of a month. Like, there's just no durability to it, with all of these perpetual shutdowns, lockdowns, holding back, in particular, services economies and people-to-people exchanges. So that's undoubtedly helping feed the property crash, and those two combining are really holding the Chinese economy back very, very heavily. What are the prospects of the Omicron regime shifting again? Well, I mean, it's certainly the case that China's given itself a goodly crisis here in terms of meeting any decent growth goals. It's got youth unemployment now 20%, the highest in history, or in modern history, which is obviously something that will deeply concern the CCP and worry about idle hands and possible rise of protests, etc., as well as some fracturing of its social compact, which is to basically extend growth and prosperity in return for fewer freedoms. So there are some pressures here. Nonetheless, the Politburo seems very determined to stick with zero COVID for the time being, at least. There's no immediate prospect of the nation being inoculated. We're still waiting for Chinese mRNA vaccines to roll out. And a lot of the age population is under vaccinated as well. So if they were to let Omicron go and just let it rip, there would be a lot of deaths. And clearly that's politically unacceptable still. So I imagine at a certain point the economic cost of this is going to catch up with Beijing, and we have this large meeting later this year with the anointment of Xi Jinping for a third term, etc. And maybe that's a pivot point, or maybe it isn't. If China's still under-vaccinated at that point, I don't necessarily see why the calculus would change. But for the time being, as long as we have these two regimes of official acceptance of property adjustment on one hand and zero COVID on the other, it looks like China is stuck in very low growth relative to what we're used to, and plausibly recession before very long as well. Just flip back to those charts, please.
One thing that could flip this quickly is if the World Health Organization downgraded Omicron to a lower sort of status of concern, which would give China cover to do the same. Yeah.
Nonetheless, it would face pretty serious mortality numbers. Doubtless they can control information flow, and so it's perhaps manageable. But
arguably, Western countries have shown that the number of deaths get ignored after a certain period.
Oh, absolutely the case. Yes. I mean, yeah. I mean, I don't know, but I mean, if their age population is not vaccinated, then they're going to have a higher mortality rate. And I mean, I think we've mentioned before, I've seen estimates as high as like 40 million deaths and stuff like that. So it won't be done in a trifling manner anyway.
Yes.
Can we throw those charts back up, please, Shelley? I've lost them. No, we've gone to the old format. That's all right. I can bring up my own version. So the various charts on Omicron, you guys can see those for yourselves, but you know they're obviously hitting the economy pretty hard. I think we've moved.
I guess actually, can I make 2 points on those?
Yep.
One is so we've got this Chinese economy losing momentum, and I just wanted to highlight on that one that property sales are obviously very negative. Retail sales started to turn down after last month looked like they were bouncing up. Fixed asset investment, which is where China's spending all this money to try and offset the property. So this is their out building infrastructure and things like that. So that's been declining for the last few months. And then there's a chart on the right which is just showing the amount of local government debt that's been issued. So they basically issued more debt by now than what they did in the whole of the last couple 2 years, and that's why we're starting to see that tail off the fixed asset investment. They're actually needing, for every dollar of fixed asset investment, they're needing more and more debt because they don't have the property sales to offset it. And basically the only thing holding us up is the export, which is still running pretty hot, but it's starting to fade. And then I've got the next chart is just sort of showing the retail sector. So, you know, it's been very bouncy, but certainly we had a big rebound in the last month, and that's really started to fade off in July. So hard to say how much of that's lockdowns and how much other factors going on, but certainly retail sales is very weak, and the consumer sector in China is tiny, and what you actually need is the consumer sector in China to grow as part of the overall economy to replace all this property building that they've been doing, and because property is such a huge part, and all the government SOE spending. And so if you're seeing a real rebalance, then China's retail sales and consumption will actually be higher than the other growth, but that's not the case. Yeah, we only had sort of 2.7% growth in the most recent quarter, or most recent month, sorry.
So can I just ask a couple of questions on that? So you said, I think exports are sort of really what's holding it all together as this property markets weaken. And is that off the back of, we've seen in COVID, a big switch of consumption to purchasing goods globally, and sort of that trend continuing, even though globally we're mostly out of lockdowns? And then I guess my question there is, we've obviously seen significant inflation, increase in energy costs, and now increasing interest rates and therefore mortgage costs. Is that possibly going to bite on that exports line?
Absolutely, it is. We've actually got a slide on that just after this section, but the next shoe to drop is in fact external demand. In fact, it's started to. You're starting to get, anecdotal flow of evidence that Chinese exports are weakening. The PMI export measures have all been soft for a while now, and you can see it in things like the US manufacturing PMIs, which are all falling really quickly, and so we expect a flipping over of the bullwhip effect, that which so choked supply chains last year, will actually reverse because inventories are so high in the Western economies from over ordering, to avoid supply chain issues, ironically, creating them in the process. But as you end up with excess inventory, that will reverse and we'll have under ordering for a period. So we expect Chinese exports to fall quite sharply through the second half of the year. So we come back to that. I just wanted to quickly cover monetary and fiscal policy before we move on.
Before you go on to that, Dave, I had a second question, which was around retail sales and Damien's comment that.
Yes, you mean Western retail sales and goods
Chinese
demand?
Retail sales. No, Chinese retail sales. Damien's comment that really China needs to get that to be a larger proportion of their GDP. But so the question is that not a function of Chinese growth, basically per capita? That that you would need.
Well, it's how they distribute that growth and the income that results, and they do that in a way that is very beneficial to the public sector, basically, which includes all of the state-owned enterprises. So they're not very good to their household sector and the consumer. Therefore, they actually starve them of revenue, or rather, not revenue, of income. And there hasn't been enough policy push to shift that to where it should be. Most of the policy settings in China encourage investment rather than rising wages and consumption, and that hasn't really changed, even though there's been a lot of rhetoric around it for many years now. Consumption growth rates have actually trailed off, as you can see in that previous chart, and consumption's just not catching up to investment, or should I say overinvestment. So.
And actually, a good sort of analogy for it is in the early stages, what a developing country does, or country that wants to go through this Gershwin growth or something they call it, where they basically you repress your consumers, so you basically take money away from them, and you use that money to go and invest. And so then you go and build a bridge, or you go and build a port and do all these other things, and that means your income actually grows really quickly when you're doing that, because you didn't have a port or you didn't have a bridge, and so. And so consumers end up better off. It's like punish you in the first part, and then you end up better off. And the idea is that over time, you gradually reduce the investing, and so investing is growing at 3%, and consumer grows at 7 or 8, and then eventually you right it. The problem in China is, and actually the problem with a lot of countries that do this, they get addicted to the investment spending, and they keep growing the investment spend at 8 or 9%, and so when the overall growth starts to fall, it actually falls on the consumers, because you're actually punishing computers to go and build your 10th bridge across the river, which has got a very low benefit. Your first bridge was great, second was good. By the time you reach your 10th, you're like, you're not doing anything. And so that's the problem now, is they need to stop building new airports and actually give consumers enough money that they can use the airports to boycott.
Of course, to do that, you have to upset a whole lot of vested interests, and in China, of course, they are embedded in the government itself, so the government has to kind of turn on itself. And secondly, you have to be willing to pass wealth, income, and therefore power. You have to be willing to decentralize it into the community and into households, and the CCP is just not very good at that for obvious reasons. So regardless of whatever the growth level is, whether it's 10% or whether it's 0%, you basically need the consumer part to be higher and the fixed asset growth to be lower. But that hasn't been the case. Fixed asset growth has been above retail sales for the last 4 or 5 years.
Yeah, well, I guess my question was that, you're sort of predicting that the growth is likely to fall, and that seems the least likely scenario in which you would see the consumer sector increase, but maybe they're not related.
It
sounds like it's more the government.
Yeah, you do. You need explicit policies to get funds out of governments and into consumers, and they don't have that.
But actually, Shelley, I mean, typically that process would involve slower growth as well.
Okay.
Because you're not over-investing anymore. So that consumption shift actually should mean lower GDP.
Okay.
But, or will involve lower GDP, but they're not prepared to either until now, have either the lower GDP or the other implications.
And actually, the other thing which we're about to get on shortly is the other way you can do it is by a higher currency. Because if you let's say the currency going up by 50%, now the wages of Chinese consumers relative to the rest of the world is much higher. They can start importing stuff and they get much better. And the things that China's selling to the world get more expensive, and so the business sector shrinks and the consumer sector rises. But China's got the opposite happening. The yuan's falling at the moment, so it's actually making things worse in a number of different ways.
Yeah. So, in addressing these various problems, China has been trying to stop, I would say, rather than stimulate, has been trying to prevent the floor from falling out via, stimulus such as it is. So there's been lots of local government area macro-prudential style easing for property. That is lifting restrictions on the number of properties you can buy, as well as, things like LVRs and the size of deposits, all these various restrictions that come in during the upcycle. A lot of them have been removed, but they've done very little. The PBOC has slashed reserve ratio requirements repeatedly and has now cut rates, I think, 2 or 3 times, and I expect there to be more of that coming. Again, though, it's done very little, and I've got a chart here just showing you the year-to-date flow of new yuan loans, and at the moment we're well below 2020, and we've actually just fallen below last year as well. Excuse me. So there's no monetary flood here, although they are trying, and M2 is rising pretty sharply. There's broad money, but M1, which is more narrow money and is more based on deposits and loans, etc., is pretty low, and there's a big kind of gap between the two. So this is kind of suggesting a liquidity trap in China, which is what you get when you have something like a property bust and you've got a lot of debt in the economy, like attached to falling asset prices, and so people either are unable to borrow or unwilling to borrow, which is pretty much what we saw during the GFC in a lot of the developed economies, and it's called a liquidity trap, because the more money you pour in, the less result you get, and this is kind of where China's monetary policy is at the moment. So I don't think that it can fix things, while the current kind of structures are, in fact, for the world, the more they try, the worse that things may get, which we'll come to a moment of, when we come to the impossible trinity. But just quickly, so monetary looks like it's pushing on a string. They tried to do fiscal policy as an offset, and we showed you the chart earlier of the faster than normal issuance of local government debt, for instance, and they're also running big federal deficits. But they're pushing on a string in fiscal as well, because it's not discrete from the property bust, in that land sales have been such a critical component of local government funding for so long, and they've crashed as a result of this property adjustment. And so there's a big revenue hole in local government investment, and so all this issuance of debt is doing is backfilling what was revenue with debt. And they've also got huge debt problems in local governments, so they don't want to also juice that too much, because that's got its own overhang for growth coming up. So fiscal policy is also pushing on a string in this sense. So the traditional levers that would generally catapult China out of this kind of threatening corrections are just not working, and we have to ask ourselves whether they even want them to work. I'm not sure that they do. So so that brings us to where this kind of all comes to a potential head for global markets, in one sense, perhaps in the financial sense, in the monetary sense, and that's China's impossible trinity. One of the reasons why so what is an impossible trinity, for starters? You've got 3 major levers for macroeconomic managers to try and influence the economy. You've got monetary policy, capital flows, and interest rates. Sorry, currency value, capital flows, and interest rates. So these three interplay in ways that can either help you lift your economy out of a difficult spot, or they can make it worse. Now, at the moment, China is stimulating enough that its currency is beginning to fall and capital is flowing out of the country. Now, that, as we discussed, is the very opposite that they want to have if they want to start transitioning towards consumption versus investment. If they want to continue with investment and unbalanced investment, then that's what this will do. But what it also does is creates all sorts of problems for China internationally. So obviously, if China's currency is going to fall, then we've just come out of this Trump trade war, and we've got all sorts of problems around Taiwan, and everybody's pretty upset with China about COVID, and a falling Chinese yuan is just going to piss everybody off. So nobody really wants to see that. And then on top of that, if that really gets going and foreign capital gets into its head that the yuan is going to fall, then you can get into a situation where capital floods out and you can't stop your currency from falling. And indeed, your local interest rates have to start to rise. Either naturally they start to rise because the capital is leaving and dumping your debt, or the central bank is forced into doing hikes. And so you can see how if you get into breaking an impossible trinity, you can quickly get yourself into a feedback loop where falling asset prices can be exacerbated by a falling currency and rising interest rates. So I don't think that this is the base case of a crisis like this taking place in China, but this is the spectre of a crisis that is partly, I think, helps explain why they're so reticent to stimulate and doing it so slowly. So, so that that gives you a pretty good sort of roundup on why domestic demand is really poor, why they're really struggling to or don't want to particularly stimulate to improve it, why their currency will probably fall, although they won't want it to crash. And then that brings us around to what we were discussing earlier, where, what's the next shoe to drop on this very difficult situation that China's already in, and that is the global environment. So as we mentioned, exports have at least been, one real powerhouse of the Chinese economy, a very large component, but that's fading fast too when we see, Fed hikes in the US starting to crimp consumer spending. That's being exacerbated further by the switch back from goods consumption that took over during COVID back to services, which it means that retail sales and consumption more widely is using up lower volumes of goods. And then, of course, you've got the energy shock globally as well, which is hammering the European economy, which is an even larger export destination for Chinese goods. And so, the next shoe to drop in China is falling exports. That's going to add, and so that's going to leave China in a pretty perilous state. You'll have its private sector really hammered by Omicron and property. You'll have its external sector getting hammered from global weakness, and its public sector will be doing what it can to pick up the slack, but it faces various inhibitions on fiscal policy. So a bit of pushing on a string in fiscal. So it's a very toxic combination for China, very difficult to manage.
Well, and also I guess that they're very reluctant to stimulate investors directly. Sorry, not investors, consumers directly.
Yes, they are, which is what they should be doing. I don't know why they hate doing it so much, but that's exactly what they should be doing. So maybe this crisis is enough to get them there. So I don't know, but the poor old Chinese consumer is supposedly the great new wave of global demand has really been horribly neglected. And a lot of the fiscal stimulus, again, has been on the supply side, really wasted tax cuts, incentive to invest, all sorts of stuff that just isn't going to work very well in this environment. So
what would sorry, maybe a bit of a dumb question, but what would stimulating consumer directly look like, or could it look like?
Well, you can just do the stuff that everybody else does. I mean, cash handouts, tax cuts, welfare boosts. Sorry?
Yeah, I was going to say increased unemployment. It's ironic, isn't it? The biggest economist country doesn't want to give money directly to its citizens, whereas all the capitalist countries did.
Yeah.
And the biggest economist country keeps sitting there and saying, they go, oh, we really need to demand to pick up for consumers. Why don't we give companies a tax cut? So they'll hire more people.
I know. I mean, it is odd. It's like they've caught, it's like this strata, this Davos man class that we have globally that sits atop just about every nation now, only has one idea. Even though you've got different systems, different matrices of demand and supply in every different economy, they've all just got the same one idea: to stimulate supply. Anyway,
tax cuts for rich people.
Yeah, tax cuts for rich people. Tax cuts for themselves. So I mean, perhaps that's not all that difficult to understand. So So where do we see this going in the year ahead? Well, I think a Chinese recession. We've already had one through the Shanghai lockdowns, but I think we're absolutely in the frame for more negative prints over the next year. Whether we actually do, I don't know, but I think that the forces are in play for that possibility, most certainly. Property, I think is just going to sort of be an L-shaped recovery when we do eventually reach the bottom, which may be by the end of the year, but will be so far down by then that, it's going to have incredible implications for all sorts of global markets. I definitely think more easing, monetary and fiscal, but it won't be enough. I think capital outflow will continue and accelerate. But on all of these issues, but then overlaid as well with the Russian invasion of Ukraine, making the possibility of a Taiwan war real. I'm not sure any CEO who currently invested a supply chain into China or Taiwan would be well received at the AGM in the event of a war, and that must factor into risk considerations at this point in time. So deglobalization, I guess, is part of it and is coming to China. And then the spectre of an external crisis, which is not impossible, but, would probably require the Federal Reserve to overshoot on tightening to get there. But, certainly I think there are a lot more fears and real problems coming to China over the next 12 months. So before we go to that question of the week, should we just wrap up markets? Or?
Yeah, actually, before we do that, we have a question. So it's from
Yes.
Cam Crick, and he wants to know if the problems that China's having at the moment put paid to the idea of them developing a new reserve currency.
Well, I mean, I never bought the idea that they were going to be able to develop a new reserve currency. I always thought it was pie in the sky because it's so contrary to the structure of their economy. Principally because if you're going to run a reserve currency, you have to be issuing a lot of debt for anybody to use it. You have to have deep capital markets and debt markets, liquid, deep, trustworthy treasury markets. And Chinese economy is just not that beast. It doesn't run deficits. With the CCP, really, is it prepared to do so? It looks very hesitant to lift consumption. So, it doesn't look like they're prepared to do what it takes to have a reserve currency that is in wide circulation. That said, there's this whole Bretton Woods 3 argument coming out of Wall Street, which is based upon, by and large, it's based upon resource nationalism. And that may play a role in helping boost circulation of the yuan. But again, I think that will be within a very limited sphere of autocratic nations. And I think it's just as likely to contain the yuan, in fact, more likely to do so if it actually turns bellicose and invades Taiwan. I think that's the end of the yuan in the Western world, if that happens. I think is that of sanctions in response to that kind of aggression, even short of having a shooting war, like being involved in the war, I think the US would probably just freeze the Chinese holdings in the US. And, the yuan will be poison to anyone that holds it. So, no, I don't see how any of this results in a rising yuan. In fact, on the contrary, I think most of it is bad for it, which is probably why it's got such poor circulation in the first place. Well, it's obviously is why.
Well, I think as well, for anyone who's concerned about the US and saying, hey, the US just seized all these Russian assets and they don't have the rights to do it. It's only because they're a reserve currency that they can get out and do that, and it's it's not fair and all that stuff like that. Is then turn around and say, well, if the US is prepared to do it, do you think China's prepared to do the same? And you'd have to say absolutely. I mean,
well, is your money safer in China? I mean, no.
Yeah, I mean, all you need to do is one of your leaders visits Taiwan when they didn't want them to, and the next thing they've seized all your assets because they decided that, that's an affront to the Chinese, Taiwanese nationalism. So, that's where
I don't know how many times we have to see arbitrary policies seizing, this pool of capital or that before people figure out that it's got major sovereign risk. But there are people that just seem to have endless money to lose. So the implications for markets. So,
do we want to go to viewer question before we do implications, Dave?
Well, I never understand why the viewer question isn't after the issues. But anyway, yes, go ahead.
Well, I think I do. I can explain to you why it is because we wanted to take the opportunity to introduce the question and also ask for any listeners if they want to put in any questions.
Okay, well, go ahead.
We come to a wrap.
Yes.
So if you're listening and you have a question you'd like the team to answer, please put them in our last call for those. Also, the viewer question, as Dave just mentioned, strangely placed, but for a reason. This week, we want to know what you think in terms of has the Great Chinese Reckoning arrived, or is this just a blip on the radar? So if you want to get your thoughts into the YouTube comments and let us know what you think, and the fellow listeners, then we look forward to hearing your thoughts and the engagement. So I don't have any other questions yet, so I'll hand it back over to you, Dave.
Okay, so wherever the yuan goes, the Australian dollar sooner or later follows. I think in today's environment where the Fed's still tightening, that's probably truer than ever. So I would expect the Australian dollar to fall as the yuan does. This second point's really pretty critical. Markets hate the falling yuan. It lifts geopolitical risk in terms of creating trade frictions. Perhaps even more importantly, it hammers broader emerging markets current account balances, both on the income side and trade side, because they get less competitive and money flows out when the yuan's falling, and which tends to make the US dollar rise, and so capital flows out back to the US. It's very deflationary, and it hammers commodities. So as long as this goes on, I expect those things would continue to happen. So we first sort of did this presentation more formally. We've been talking about this really for over a year, but In May, we did it again, and we said, it'd be sort of 2015 and 2018 on steroids, and so far that's basically played out. Like commodities have been hammered since then. Bonds sold for a while and then got heavily bid back in, and now are up a little on that period. I would think those things would all continue, as a falling yuan just really intensifies the risk of a global hard landing, as all of these feedback loops intensify. So yeah, I mean, China looks like the only path out that it's prepared to take is a little lower yuan, but unfortunately for the world, that's the path that hurts most.
Well, and for the Chinese consumer.
Well, yeah, and for most Chinese, yes.
Yeah.
Yes, but it's not really about most Chinese, is it?
No.
So that's the general implications. I'm just wondering if you can tell us more specifically how they're reflected in the Nucleus Wealth and macro business models at the moment, or portfolios.
You want to take that one,
sure.
Damo?
Yeah, so we bought more bonds as yields are sort of yields are sort of in this latest up leg. We've sort of been, I guess, more confident of that. We've been underweight commodities for some time, and so that's so that's obviously been helping. And now the question is, is that, are there risks now, in are there sort of flow-on risks from these in terms of banks? And we have been lightening up a little bit on the banks with the view that, there are risks, that there are more tail risks emerging from this. And so we're in a pretty decent bear market rally at the moment. And so the question for us is, just whether we continue to lighten up and sort of take some of those profits from recent and sort of get ready for the next down leg.
Thanks, Damien. So, guys, not so much a question, but we do have a viewer comment that I thought worth highlighting and getting your thoughts on. So, Yuchen Lu says, I don't think China is pushing the yuan to become a global reserve currency. It's only trying to lower its dependency on the US dollars. I thought that was a really interesting point. I wanted to ask if either you wanted to comment on that.
Yeah, well, I mean, it may be sort of trying to a little get away from the US dollar, but it's still got a dirty peg to the US dollar, so it hasn't gotten very far away. And it's
does
still
sort of go back to your point before, Dave, about when your assets are in that position, you're sort of the whole.
Look, absolutely, but they are damned if they do and damned if they don't here. Because they've had this dirty peg in place to keep themselves competitive and supply the US consumer, and they didn't want to have a rising currency, and so recycled all of their earnings into US debt, which now makes them vulnerable in a geopolitical sense. But and they're trying to manage in and out of that at the same time. Like so much of China is like this, where you're kind of got a foot on the accelerator and the brake at the same time.
Can I just explain that quickly? Is that ordinarily what would happen is if Australia, say, exports a lot of goods to the US, and the US buys a lot of Australian goods, there's this demand for the Australian dollar, and the Australian dollar rises until that sort of cancels out, and then you lose that demand. Australia starts to, Australian dollar gets to a parity with the US dollar, and all of a sudden everyone's buying everything they can from the US because it's much cheaper, and so that sort of evens you out. Whereas what China's been doing is, yes, they've been selling a lot of the goods to them, and then as the money comes back, China's been the government's then so that a corporate sells $1,000 worth of goods to the US and then brings $1,000 back to Yuan, and the Chinese government's been then selling the $1,000 and going back and buying US government bonds with that, and so sterilizing that and keeping the currency low, so you never get that equalization coming back. Yeah, and that's the issue, is they've been avoiding enriching their own citizens in order to keep employment going and the export thing going, and so that's a lot of what Trump was complaining about, and others, in terms of manipulating currencies for trade purposes. Yeah.
So yeah, they don't like the fact that they're exposed to the US dollar and the risks that come with it. And yes, they have tried to diversify, but it's the model they created for themselves. So, they can only get away from it so far. Not very far, to be honest. So they still hold, I think, they've got about 3 trillion in US assets, and about half of that is treasuries. So, they're still recycling a lot of money into the US, just rather than diversifying.
Or let the currency rise.
Yeah. Yeah.
All right. Any last comments, gents, or shall I wrap it up?
Sounds good. Okay, I just want to say thanks, Shelley, for filling in for Sam. Sam's off this week, and so she's done a stellar job. Sorry for any. I think there's almost a false positive there. She thought there was problems where there weren't problems. She's done a better job than what she thought she was doing. So thanks, Shelley.
My pleasure. Thanks for having me, guys. I just hope the listeners got a smoother ride than I had.
Yeah.
All right. Well, thanks, Dave and Damien, for your insights and your time on the show today. I hope everyone who's listened has found it insightful. I know how I have. Moving forward, just want to let everyone know that we love to hear your feedback on the show, especially in regards to future topic suggestions. So please get in touch with us if you have something. Some thoughts or comments, contact@nucleuswealth.com. Also a reminder that anything or any advice in this podcast is general in nature, and it's not going to take into account your personal circumstances. So if there is anything personal you'd like to discuss around your financial situation, you can get in touch with us at nucleuswealth.com/contact, and you can book a call with Samuel to discuss anything you'd like to. Also, if you have enjoyed the show, we would love to get a like from you. It helps us to grow the show and continuing to keep bringing you really great content. So for myself, Damien and Dave and the rest of the team at Nucleus Wealth, thanks for watching and listening, and we look forward to seeing you next time.